In our last report in September, we commented on the particularly large volume of transactions in legals across all sectors of the commercial property market. Over the course of the last 2 months, some of these transactions have since completed and in turn boosted Q3 transaction volumes. However, with only 2 months to go to year end, there's still a large volume of transactions still to complete. There will therefore be a flurry of activity over the next couple of weeks to get transactions completed by year end, although inevitably at this stage, some of those transactions will now carry over into 2020. Interestingly, despite heightened Brexit noise over the last 2 months, activity has been brisk across all sectors of the Irish market, and at this juncture, there is good visibility on pipeline for the year ahead. Budget 2020 increased the rate of stamp duty for non-residential property transactions from 6% to 7.5% from midnight on October 8th, a measure which will have implications for property values. Several other property-related measures were announced in the budget, which investors are now digesting to determine the specific implications for their property portfolios and their investment strategies. Unfortunately, the introduction of unexpected measures by government, as was done in the budget, has the potential to create reputational risk for Ireland among institutional investors. From a delivery perspective, increases in construction price inflation and the cost of adhering to new near-zero energy rating regulations which come into force on the 1st of November has added to viability concerns in several sectors of the market over recent months. Despite all the noise around Brexit over recent months, which may have resulted in some occupiers putting expansion and location decisions on hold, activity in the Dublin office market has continued at pace regardless. More than 192,000 square metres of office space was leased in the year to the end of September, and with a further 153,000 square metres reserved at the end of the quarter, this bodes well for a strong Q4 if these transactions complete before year end. However, legals are proving slow and cumbersome, so the likelihood is that some of the current office leasing transactions may now not complete until Q1 2020. Demand for office accommodation remains elevated, with more than half of current demand focused on city centre locations, although recently we have seen increased activity in the suburbs, with exactly half of all activity in Q3 occurring in suburban locations, and indeed 2 of the largest transactions in the quarter were located in the south suburbs of Dublin City. Almost 225,000 square metres of transaction activity was recorded in the industrial and logistics market in Dublin in the first 3 quarters of the year, up 7% on the same period last year. Several other transactions are currently reserved or in legals, which should boost Q4 take-up. Meanwhile, bids have now been received for the Compass industrial portfolio, which was offered to the market recently, guiding €28.5 million. Demand for well-located industrial sites remains strong, with several searches ongoing at present from a range of different user types, including distribution centres and data centres. We've seen some increase in prime headline rents in the Dublin industrial market in the last couple of months, with prime rents now trending at about €110 per square metre or €10.25 per square foot. Although consumer sentiment has understandably been negatively impacted by all of the political discussions over Brexit over the last couple of weeks and months, the Irish retail market has demonstrated remarkable resilience. The volume of retail sales is up year on year. We continue to see good levels of activity from a property perspective, with strong demand for new stores in high footfall locations from both the food and beverage, athletic leisure and sports sectors. The focus for the next 2 months, however, will be on getting existing transactions signed as opposed to launching new sales mandates, with retailers focusing instead on their core businesses during the busiest 2 trading months of the year in the run-up to Black Friday, Cyber Monday, Christmas and New Year. Returns from commercial property will be somewhat negatively impacted in Q4 following the recent increase in stamp duty for non-residential trades from 6% to 7.5% in last month's budget. At this juncture, investors are taking time to consider the potential implications of the recent increase in stamp duty, along with other property-related measures announced in the budget, and seeing what implications this has for their portfolios and investment strategies. In any event, the investment market is on target to achieve very strong levels of activity in this year, taking into consideration the deals that have been signed to date and the volume of transactions in legals at present, including several off-market trades. Investment spend in the first 9 months of the year came in at about 3.3 billion and has potential to reach a new record of 5 billion by year end, depending on what transactions sign before the end of the year. Prime yields across all sectors remain stable in the Irish market at present as we approach year end, other than for retail yields, which have experienced some further softening over recent months. For the second quarter running, the volume of spend on build to rent or multifamily has exceeded offices and other sectors, accounting for 46% of total spend in the year to the end of September. Demand for this sector continues unabated, with particularly strong appetite for lot sizes of between 50 million and 100 million at present. Investors are increasingly opting to forward commit to schemes in order to secure product in the absence of sufficient standing stock to satisfy investor appetite. However, investors want access to product that is deliverable in the short to medium term, as opposed to committing to schemes that are too early in the development or in the planning process. There is increasing concern about rising build cost inflation, which can have a significant impact on deliverability and ultimately on target returns. As we approach year end, it is clear that there's a good amount of build to rent stock in the planning process. Ensuring that this product is viable and deliverable is now a significant challenge, particularly considering the implication of recent budget changes, rising build costs and NZ regulations which have now come into force. Developers with a contracting arm will undoubtedly be best placed to ensure deliverability. More than 800 million of development land transactions completed in Ireland in the first 9 months of the year in 47 individual land sales. Some transactions signed in Q3, including some large ones like the DIT campus at Kevin Street in Dublin 8 for 140 million, boosting spend in the year to date. First round bids have now been submitted for the glass bottle site in Dublin 4, which had been guiding in excess of 125 million, with the preferred bidder likely to be announced for this site in the first quarter of next year. While Budget 2020 is now behind us and the industry broadly welcomed the decision to retain the Help to Buy scheme for a further 2-year period, the market is now anxiously awaiting a decision from the central bank, which is due later this month, on whether there will be any changes to their macroprudential policy. This could have a bearing on the volume of new housing delivery in the Irish market in 2020. The market is also awaiting news on potential changes to what classifies or qualifies as strategic infrastructure for planning purposes, as well as some other expected changes to the Strategic Housing Development Scheme. Near zero energy build NZ regulations are now in force since the 1st of November for all new dwellings and extensions or refurbishments where the surface of the building increases by more than 25%. This will have negative implications for viability at a time when recent hikes in stamp duty and rising build cost inflation are already impacting significantly on viability and pricing. 16 hotel sales totalling more than 304 million transacted in the Irish market in the year to the end of September. Demand continues to outstrip supply, particularly for hotels and apart hotel opportunities in Dublin city centre, which has been really evident from recent sales mandates and operator selection processes. The volume of pent-up demand for prime hotel opportunities and the depth of capital looking to deploy is encouraging some vendors to consider bringing their assets to the market. At this juncture, we've visibility on a good pipeline of hotel product due to be launched for sale in the first half of 2020, including some Dublin properties. Investors continue to seek out investment opportunities in the healthcare sector in the Irish market, with a notable increase in demand from European funds to deploy capital into this sector of the market during the last 12 months. A French fund has been particularly active of late, having acquired several nursing home properties around the country in the last couple of months alone. Investors appear to be prepared to acquire assets using several different structures, including sale and leaseback, where existing operators are remaining in situ, and in other cases purchasing operational businesses and putting in place long-term leases to specialist operators in other situations. Many of these transactions are being done off-market. In addition, a number of entities are assembling portfolios of nursing home sites with a view to putting institutionally acceptable leases in place and securing funding on this basis. As we approach year-end, we expect to see a continued arrival of new European funds looking to deploy and looking to identify routes to unlock product in the Irish healthcare sector. The months of September and October have been relatively quiet in the commercial property market in Cork, with very little of scale or significance announced recently, either from an occupier or investment viewpoint. There are several sizable office occupier transactions in negotiations, but it does remain to be seen whether these will transact in 2019 or whether some of these will now fall into 2020. Meanwhile, development continues on a number of schemes across the city, with an ever-increasing number of cranes visible on the Cork horizon. Appetite for prime development land remains steady, although there's very little supply being offered to the market in Cork at present. While residential development is certainly underway, it's exclusively for housing, with apartment viability in the city remaining severely compromised, and this is a situation that is unlikely to change without some form of government intervention. And so we conclude our final bi-monthly report for 2019. The focus for all sectors of the market now is to get deals across the line before the end of the year. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.